Okay. Uh, Good evening and welcome to the session. The course is Introduction to Accounting and Finance for Civil Engineers. The course instructors are Professor Sudhir Mishra from IIT Kanpur and Professor K. Jha from IIT Delhi. This is related to week 4 contents. I am Venugopal Mahajan, a research fellow at IIT Delhi. This is an interactive session, so please feel free to use your mics, raise your hands anytime you feel any doubt. If you participate in the session will go along very fast and informative for both of us. Okay. Uh, so, moving to the contents, this session will be discussing replacement analysis and risk analysis. So we start with the basics of what cost do we consider. There is a mixer grinder model M that you purchased 2 years ago for rupees 1600, and it has straight line depreciation for 4 year life and zero salvage value. Because of recent innovations, now you can buy the same model for rupees 1000. The original trader has offered you that if you buy the new model N for rupees 1400, he will take this for rupees 350. You have seen such deals very often. But when you see other sites, you know that model N can be purchased for rupees 1200. So the originally quoted price for model N was overstated to allow a larger trade-in allowance. But the true current market value of model M is probably only 200. Like if you just take your mixer today and go to the market and sell, you will fetch only rupees 200. So the question is, in the replacement analysis, what would be the value assigned to model M? Now, what are the different values for model M? Let's see. We have got its purchase price at 1600. Now its current market price at 1000. Then the trader is ready to give you 350 rupees for this. Then salvage value, if you calculate, okay, salvage if you calculate, it would be what, 1600, zero depreciation value in 4 years. So for 2 years, it would be 800, right? You can calculate it, and then uh, you know that the market price right now is 200. So out of these five values, which which one will you consider for replacement analysis? Mm, I will need your answer to move forward. Okay, so we will take rupees 200. Why? Because today the true current market value is only rupees 200. We are not uh, interested in its salvage value, or uh, we are not interested in the hyped market price today, or what the trader is going to give us. What the true market value is, that should be the value assigned to model M. So we have got it as 200. Now, in the proper replacement analysis, what should be taken as the first cost of model N? For model N, what prices do we have? Model N, you can see that you have got 1400 and 1200. So, instead of going for the sellers, we know that the current market price is rupees 1200. So, we'll take it as rupees 1200. Now the question is, if the model N has the life of 3 years with zero salvage value, what is the difference in their annual capital cost? Uh, yeah. So how to calculate this part? Now you would say that today model N is for 1200 rupees, model M market price is 200. So one way could be 1200 minus 200, that's your present value. Then bringing it to Annualized cost, it would be A given P, I is equal to 10% and N is equal to 3. So is this the correct way? No, you shouldn't be going like that. What should be the correct way is uh, net for 1200, you know that it is going to last 3 years, minus 200 that you know is going to last you rest of its life, 2 years, 4 minus 2. So this would have given you the this expression would have given you the correct value. Any confusion regarding how we got this expression, or how we determine the value for model M and model N? Okay, so moving forward, a hospital is considering the purchase of a new equipment that costs rupees 30 lakh, and there is no salvage value even after the first year. So you have been given what you have been given. You have been given the initial cost, salvage value is 0. Then each year you have been given the operating cost of rupees 1.5 lakh per year. And after 10 years, you have to discard the machine. So that makes your useful life as 10 years. Now the question is, what is the most economic life of this machine? So how do we calculate it? How do we calculate that part? We have seen in most economic analysis, we have done the analysis by taking each and every year's initial cost, salvage value if we sell it that year, operations and maintenance for that year, then analyzing it, all that process. So in this case, how can you find your most economic life? Will it be 1 year, since we don't have any salvage value at the end of first year? Or will it be 10 years because maintenance is not increasing? Or it will be somewhere between 1 and 10 years, but we need to do further calculations. What do you think? What do you guys think? Okay, you have got three options in front of you. What will you pick? Hmm, any answer, any option that you like? You have already gone through week 5, week 6 contents. Okay, so if you take 1 year, uh,
What is sorry,
yeah,
sorry. What is the meaning that the site center as the cost of removal equals any resale value? What it means actually?
okay. So what is happening is that they're telling you that we have installed the machine for rupees 30 lakh. Let's say that after end of 2 years we are reselling it. So the reselling cost is 1.5 lakhs, but the modification that is now required in the hospital, taking the machine away, moving the equipment and all, so that is also costing the same 1.5 lakh. So the net salvage or net resale value is 0. So did you get this that statement now? Okay, so how will you determine its most economic life? First of all, is most economic life equal to its useful life? No, we have seen in class many examples where we have got the value somewhere in between. It can be its most useful life also. So let's try to calculate. If we have got three options, A, B, and C. For C, but more information is needed. If A and B prove wrong, we'll be taking C. Okay. Uh, yeah. So 1 year, if you take 1 year, then the annualized cost would be, if initial cost is 30, 30 lakh and salvage value is 0. So if this is your P, so you can directly go A given P, I is not given, and 1. Okay. In second case, 10 years because maintenance cost doesn't increase. Okay, here is some maintenance cost also. In second case, how much it would be? It would be 30 A given P I comma 10 plus M. What you see is that if you go increasing your N value from 1 to 10 and M is fixed. So if let's say I'm interested in I is equal to 5, then it would be 30. No, I not I is equal to 5, N is equal to 5. 5 plus M, some value. At the end of 10th year, we are getting this phrase. And we know that this value will always be greater than this value. Similarly, you can go till 1 to 9. So that way you can say that 10 years and you are getting this answer only because maintenance cost is fixed. It is not varying. If it varied, you might get different answer. So yeah, we don't have to look into for C. Yeah. Moving on to the next question. An equipment which was purchased at a cost of rupees 22,000 4 years ago is considered for replacement against a challenger whose cost is rupees 18,000. The existing equipment can be traded today at rupees 6,000 and if kept for another 6 years will have salvage value of rupees 2,000. The annual maintenance cost of existing asset is rupees 7,000. The challenger has an annual operating cost of rupees 3,500 and its salvage value is rupees 3,000 at the end of year 6. I is equal to 15%. Now you have to pick which is the right option. So how would you proceed? So how can we proceed in this case? The question is in front of you. We have got a challenger that is the equipment that is already there. No, sorry, challenger is the new one. We have got a defender here that you purchased 4 years ago, right? So how to proceed, or what will we do? Anything? You have got the question in front of you. I will need some help doing this question. Okay. Maybe I should start solving it and then you will help. So what you have got is you have got a defender. Okay. You have got a challenger. What you are interested is in that if I am deciding right now uh, which of the following is which of them is less economical. I mean, which you will you will reject that, right? So for the defender, we have been given that the initial cost is rupees 22,000. That was 4 years ago. But today its cost is given 6,000, right? So what we do first is let's make a cash flow diagram for this. If you are paying 6,000 each year, or only at the first year, right? Not even at the first year. At the time t is equal to 0, right? So that will be, and then what happens next? You have got that its annual maintenance cost is 7,000. For how long? Till for 6 years, right? and at the end of 6 years the salvage value is 2000. Similarly, for the challenger, if you have to draw the cash flow, how would it be? Its cost is given to us as 18,000. The annual operating cost is 3500. Yeah, and its salvage value is 3000. Now, how to compare these two? Obviously, you have been given I is equal to 15%. Let me take you back to the question. Okay, so we have been given I is equal to 15% and some other values. Are you guys following till now? Okay. So how to compare these two? Uh, let's let's compare challenger over defender. Okay. So if that gives you a positive NPV, then it's okay, right? So 12,000, but for next each year 35 7,000 minus. I mean, initially you were paying 7,000, so now you are paying only 3,500. So you have got 3,500 plus, right? For next 6 years. 1, 2, 3, 4, 5, 6, and at the end of 6 years, again you have got 1,000 rupees salvage value. This is what? Challenger over defender. So let's calculate the NPV. What would be NPV? Minus 12,000 is, yeah, plus 3,500. P given A, I is 15%, and N is how much? Yeah, N is 6, plus 1,000. P given F, I is 15%, and N is 6. Taking these values, uh, we have been given A given P and A given F. Yeah, so either we can convert this into a equivalent annual cost. So can you guys use the same given values to calculate it right now? Calculate these factors, or should we write the equation again in terms of annual worth? Some answers, guys. At least something. Okay, so if you have to determine this P given A factor, this will be 1 upon A given P, right? So this is 1 by 2642, and for P given F, uh, you can have 2642, that gives you P by A into A by F, right? So A by F you have 0.1142. So what is the NPV in this case? Can you calculate? Okay, I will give you some time to calculate this. Okay, this becomes minus 12,000. This is 35 100 divided by 0.2642, that is plus 13247.54. So even if I don't calculate rest, I know that with the third value coming something positive and this positive value is greater than minus 12,000, so NPV is positive. So if NPV is positive, so we know that the Challenger is the better option. So now let's go and see what the options we had. The equipment annual cost of Challenger is more than the Defender. It would be economical to replace existing equipment. So now we have got the values. Can you guys help answer A, B, C, or D? Or do we have to calculate the equipment annual cost then and only then you can answer? Any answer would be good enough right now. This is supposed to be an interactive session, that's why we are having it live. You guys can hear me clearly, right? Or is there some lag or effect? Please let me know if you can hear me clearly and see the screen.
Yes, yes, sir. It's okay, audible.
Okay. Uh, so what I will do is I will leave this for you now. I have already solved, I have given the numerical values. Now how to analyze it, that's the main part, and I would leave it for you guys to do. Okay. So now coming to risk analysis. In risk analysis, you saw that till now what we were doing is that we were having some values. Okay. But we were having some estimates and we were considering them to be accurate. Then we went into sensitivity analysis and we thought what would happen if these values are not accurate. If they vary by 10% or 20%, then we found out which variables were sensitive. Even till that point, we didn't give any probability to that. So now we'll be giving the probabilities. Okay, so starting with very simple probability question, that this is the probability that the machine will last a certain number of years. What is the expected life of the machine? So how will we solve this? The question is very simple. What is the expected life of the machine? Any answer? Or how to calculate it? Okay, so what we would be doing in this case is that simple formula, probability of each incident into uh, each life, and sum it up, right? So it would be 0.15 into 15 into 10 plus zero point 0.2 into 11 plus 0.25 into 12 plus zero point 0.2 into 13 plus 0.15 into 14 plus zero point 0.5 into 15, and this value comes to be okay. Let's see what this value comes. 1.5. This is 2.2. This is 4, right? No, 3. And this becomes 2.6. This becomes 2.1. 15 into 0.5, 7.5. So sum is somewhere around.
19.3.
Is it coming 19.3? But my answer is coming something like 12.15. No, no, no. Wait.
19.3.
Yeah, so what did we do wrong here? I mean, if the life can only be between 10 to 15 years, then how are we getting a larger value? Yeah, do you get my question? Like, if this is the probability, and if you start drawing the curve, like by 12, you are getting some values like, okay, yeah, I calculated this figure wrong now. This is wrong. This is not 2.1. Similarly, did I make this mistake somewhere else? Or was it correct? I mean, see, it should be somewhere between, if you calculate the probability distribution, it should be somewhere around 12 only, 12 and 13 only. Right, this is the formula, and this should be the value. Okay, yeah. Another mistake here. This is 0.05, so this becomes 0.75, right? See, you guys will need to correct me here because I am. I mean, yeah, right now it's in front of you, the mistakes I'm making. Yeah, so now you know how to calculate the probability expected value when some probability is given. Some is specific. You have not been given some distribution, but the specific probability of that event. Okay, do you guys have any question related to the first topic that we covered, replacement analysis? Uh, no question related to replacement analysis? Can you guys just give me a go ahead so that I can move on? Okay, anybody? I mean, or do you want to repeat the replacement analysis questions? What happened and why did it happen? Things like that. This is an interactive session. I mean, I can also sit like you guys. Okay, so we will try to move ahead. So the question is what these the further questions for this topic have been taken from one very nice book. It covers multiple types of questions. I'll give you the reference at the end. So what are the probability distribution for the annual benefit and life of the project? Now, as you can see, what is happening here is that you have got different probabilities, different values for your annual benefit also and for life also. These things, for initial calculations, we were considering them to be fixed, and then we were varying by just some values, right? So in this case, what is happening is that you have been given uh, the probabilities. So let's talk about annual benefits first. Okay. what values do we have? You have got lower one as 5,000, most likely as 8,000, and highest likely value as 10,000. What are their probability distribution? For 5,000, you have got 30% chance. For 8,000, you have got 60% chance. So, what is the chance that you will get 10,000? Right, that can be done by 1 minus 1 minus 0.3 plus 0.6. That gives you the value of 0.1. Right, and similarly for life, what you have been given, there are two options only, 6 years and 9 years, and life of 6 years is twice as likely as life of 9 years. So that means if this is p, this becomes 2p. So p plus 2p is equal to 1, right? So this becomes 0.67 and 0.33. Now the question is, use expected values of annual benefits in life to estimate the present worth when the first cost is given. See, there is no estimate given in the case of first cost. Why? Because you know this directly. This is the one that you can know very well. If you just go to the market and ask, you will know the value, right? So now one way to do would be, you calculate expected value of annual benefits. How much it would be? It would be, right, 5,000 into 0.3, 8,000 into 0.6, 10,000 into 0.1. How much is it? Is it coming? And similarly, you can calculate it for this also. Uh, in this case, it would be 4 plus 3, right? 7 years. And annual benefits, do check if I am making any mistake. This will be 1,000, this will be 4,800, and then this will be 1,500, right? So that is 7,300. Now I has been given, so estimate the present worth. So present worth would be minus 25,000 plus 7,300, a given p or p given a, p given a, for what period? For 7 years, right? That is our expected value. Any confusion till now? Or how we got this table? How we got this equation? Anything? Okay, so from table it is 4.86. So this comes around to be, let's calculate it. Um, mm, okay, so you calculated both the things, probability distribution for each, right? And you also calculated the present worth. So now my question to you is this the right way to go, or is there any way that you can get a different present value or something more accurate? This is kind of a conceptual question. Okay, so can anybody of you explain what did we do right now? See, we have not we have been taking into account the probability of these singular events only. When we know that these events don't occur exclusively, right? I mean, they both occur simultaneously, right? For each case, you can have 5,000 as your annual benefit, and life can be 6 years or 9 years. Do you get that point? Anybody? I mean, either you explain what we did, or you tell me what is missing. Sorry. Okay. So you got some probability distribution, but if you were to tabulate it, you can tabulate it right like this, right? That annual benefit and life, this can be 5,000, 8,000, 10,000, and for each you can have life as 6 or 9, right? So what we can have is you can have uh, 6 different values. Now, how to calculate the probability? So we note that the probability of this was zero point 0.3, zero point 0.6, and zero point 0.1, right? Zero point 0.6, zero point 0.1, and for these events it was 6 or 9. It was 6, 7, or 0.33, right? So joint probability, I mean, joint probability, why is this term? That probability of these two things, like 5,000 is your annual benefit, but the life is 9 years. So can you calculate it? So you would say that the probability is, okay, can anybody of you calculate this? What is the probability of both these things happening? Joint probability? Do you guys get my question? We are talking about joint probability because further on, as we move on to decision making, we will be talking in terms of this only. So first of all, do you guys know what joint probability is? Any answer would be a good answer right now. Okay, so to calculate the joint probability for this event, or you can write it 1 by 3, right? So it gives you zero point 0.1. Similarly, for others also you can calculate this zero point 0.3 into 0.67, it's zero point 0.2. For this zero point 0.6 into 0.67, so 2 coming from both sides, it would be somewhere around 40, right? 0 0.1 into 0.33, this is 0.3, 0.1 into 0.67, 0.67, 0.33, right? Am I writing the right values? Any answer, guys? This is again point two. So for each of these events, like for annual benefit of 5,000 and for life of 6, you can calculate the NPV, right? And for that NPV, you have got joint probability. So just multiply them and add them, so you will get the expected value. And this value will be different from the previous one calculated. So which of these values is correct? I mean, you are getting two values, right? Two different expected values. They are very close to each other, but still they are different. So which one of them would be correct? Okay, I will. I mean, this again I will leave it for you guys. Calculate it and then we'll see what happens. Now, coming to another question. Yeah, this is quite worded. So what is happening is that there is one agency that is considering to purchase a new equipment, and for this they have determined that the equipment will cost $500,000 and is expected to last 8 years. Now, what about the savings per year and salvage value? For that, they have given that there is 20% probability that savings per year would be 65,000 and salvage value would be 40,000. Similarly, there is 50% probability that savings per year would be 82,000 and salvage value would be 55,000 at the end of 8 years that has been given to you, right? Uh, so the question here is that determine the NPW. Now we have seen two different cases, right? We have seen the case of joint probability also, but here as you can see that these are mutually exclusive events. I mean, you have been given that uh, for $65,000 per year savings, you will get the salvage value of 40%, 40,000, and the whole has the probability of zero point 0.2. So you don't have to go into joint probability, right? So if you don't have to go into joint probability, you can work in terms of single probabilities. So what we find out here is that let's calculate savings per year, expected savings per year. So it would simply be multiplying these two values and adding them, right? Okay, let me write it. Expected savings zero point 0.2 into 65,000 plus 0.5 into 82. Let these values be in terms of 1000 only. Uh, Plus 0.25 into 90 plus 0.05 into 105. And how much does it come? Okay. Similarly, expected salvage value you can calculate, right? 0.2 into 40 plus 0.5 into 55 plus 0.25 into 65 plus 0.05 into 75. Okay, so this comes around 81.750. So we will write uh, 81750, and similarly this will come around 55.5. So yeah, 55,500. So NPW, what would be the NPW? It would be the initial cost is 500,000, right? Plus 81,750. This is A, so P given A, I is 6%, and life is 8, and this becomes what? Yeah, 55,500. P given F, again 6% and 8. So let me get these values from the table. Are you guys following what we are doing right now? Any confusion? What the equation we have written? I mean, it is quite simple, but the point is that we discussed joint probability, and yet again we went for single probability only. Anything? So this is 6.2098, and for P given F we have 0.6274. So this value comes out to be, can you, are you guys calculating with me? Okay, so this value comes out somewhere around 42,500. So yeah, we have calculated the NPV, and we saw similar approach that we applied in the first while calculating expected life. Okay, so this next question brings you close to the title, like Introduction to Accounting and Finance for Civil Engineers. So now you have a decision to make. Hmm. You guys are here right now, right? Okay. So a dam is being considered to reduce river flooding in the Forked River Basin. Information concerning the possible alternatives is given. Which dam height minimizes the expected total annual cost? The state uses an interest rate of 5% for flood protection projects, and all dams must lie 50 years. So now what information have you been given? Uh, so you know that dams also have this property that they help in mitigating floods. They obviously have other benefits and other costs associated with them also. And we have seen many in India. We have seen many protests regarding the increasing the height of dam. So when you increase the height of the dam, you have got benefits like more water in the reservoir, so more power production, and the flooded area, the reservoir basin may increase, so more area gets inundated, and so this is kind of a complicated equation. But in your case, you have been given quite simple things that have been already determined. Now coming to the interest rate, in government projects you usually take 5% or even less to calculate. Then dams must lie 50 years. 50 years in our case, in these calculations, it is almost equal to perpetuity, to infinity. So now what have you been given? You have been given the dam height. You have been given the first cost, the annual probability of flood, and damage if flooding occurs. So in case that there is no dam built, so you know that the this cost would be zero. But what about the damage due to flood? So there is 25% probability that flood will occur, annual probability. So this year the probability of flood occurring is 25%. So the damages if flooding occurs, how much does it become? So you can say that it is 0.25 into 800,000. So that is 200,000. Similarly, if the dam height is 20 feet, the first cost is 700,000. The probability that you will get a bigger flood is 0.05, and the damage if flooding occurs is given to you 500,000. So if I cost is annual damages, so what would be the value here? I mean, it's simply 0.05 into 500. Anybody? This comes to be 25,000, right? This is 3,000, and this is even less, 400. Have I calculated these values correctly? Okay. Have you guys followed me till here? I will only move. Okay, I will wait for a minute. I will let you read the question again, see what is happening. Uh, Anybody, any doubt till here? Okay. Anything? If not, I will move ahead. So, what can be your uh, annual cost for each case? Can you give me the equation? Okay. So, for the first case, we know that its annual cost is, I mean, equivalent annual cost is 200,000, right? Equal to the damages. In second case, uh, what will be? It would be 700,000 by, uh, I mean, 700,000 by what value? I mean, it can be given as this is present value, right? So A given P, I is what is I? 5%, and N is 50 years. So if we take 50 as infinity, this becomes 0.05, right? Is this correct? I mean, any answer would be good enough right now. Okay, so I will move on with this only. I will take it as 0.05. I mean, I will take it as infinity. So this actually becomes 700,000 into 0.05 plus 25,000. So how much is this value? This is 35,000 plus 25,000, 60,000, right? Similarly, for third case, EAC would be equal to 800,000 into 0.05 plus 3,000, right? So it would be 43,000. In fourth case, it would be 900,000 into 0.05 plus 400 is equal to 45,400. So you can see that the least value is 43,000. So if you have to choose the best alternative, so you would say 30 feet height would be preferred. It has less equivalent annual cost, right? Any question? And this decision you based on only what values you have been given, and only one factor was considered, the flooding part. Any question till here, or any question related to assignments, anything? The topics we are covering are replacement analysis and risk analysis. So, any questions related to these topics or the previous ones that have been already covered? Okay, so moving on to another question. So, you have been given a decision tree here. So, we will try to understand decision tree from this figure. So, what you have been given is, you guys are familiar with decision tree, right? Anybody who has not done such question, or okay, what is a decision tree? Anybody? Okay. So what decision should be made on the new product summarized in the following figure? What is the expected value of the product's present worth? You have to calculate it. Firm uses an interest rate of 10% to evaluate the project. You have been given as equal to 10%. Uh, if the product is terminated after 1 year, the capital equipment has a salvage value of 55. I mean, 5,000. Sorry, 550,000 for use with other new products. If the equipment is used for 8 years, the salvage value is 0. So now let's see what has been given. Now, the first choice you have is, do you want to build the product or not? If no, that means you are not incurring any cost. If yes, you have got the first cost of 1 million. So, but in this case, you haven't been given any probability. Why so? Okay, moving on. I mean, this is something, yeah. So now you have chosen to build the new product. Now it might happen that this product is quite, you have now three probabilities. Either this product can be very popular, or not very popular but somewhat popular, or very low in popularity. So in case of low volume, you have got P is equal to 30%. There is 30% chance that it would be low volume. So when will you know that it is low volume? At the end of first year, of course. So at the end of first year, you have got revenue of 100,000. Now, uh, you have another choice, right? So let's see that what happens at the end of first year. If you have got medium volume, it's 60% chance that you will get medium volume. That means that your net revenue is 200,000, and 10% chance that it would be high volume, giving you a net revenue of 400,000 at the end of first year. Now, after first year, what happens? If you have got low volume, you again have two choices that, oh, it is not giving me enough, so let me get out of this project. So you terminate this project. So you get a salvage value of 550,000, or you or you say that, okay, let's continue with it. I've already invested. Let's see what happens. So you get a revenue of 100,000 per year. In case of medium volume, you are happy with that. That, okay, I am getting 200,000, so let it be. So you are getting 200,000 for the next time, next life. Now, if you are getting very high volume, in case of high volume, you are quite interested. So you say, let's expand it. So if you expand it, you will have to spend another 800,000. That will increase your net revenue to 600,000 from 400,000 that you got in first year. Or you can say that, okay, let's continue. In that case, you will be getting 400,000 per year. So I hope you can see these and understand the decision tree that has been given to you. So let's say, how many options do you have? At first node, you have got two, right? Do you want to, at first node, you have got two options. Do you want to make, mm, or I mean, do you want to invest in the project or not? So at the end of, if you decide to make, at the end of first year, you have got again some decision to make. So the question is, you have to calculate the expected value of product's present worth. So how many present worth can you see here? You can see this will give you some value. This again will give you some value. This will give you some value. This will give you some value, and this will give you some value. From that, you bring back and you compare it at time t is equal to 0. Now let's see comparing for each and every node. Okay. So if I'm considering this, what is happening is that at the end of first year, I am selling my equipment. So what is my cash flow? At time, uh, okay, at time t is equal to 0, I am spending 1 million. At time t is equal to 1, I am getting 550 of the salvage value and 100 of the net revenue, right? In another case, what is happening is that you are spending 1000 initially, and for next 8 years you are getting some value. How much is it? 100,000, right? For 8 years. So can you calculate the life here in both these cases, the NPV? Uh, Guys, do you understand this cash flow? Have I done any mistake, or are we moving in the right direction? Okay, I is equal to 10% that has been given to us. What shall we do next? Okay, so for this case, your cost becomes minus 1000 plus, at the end of, you have 650 divided by 1.1, that is the formula, right? So what is the value that you are getting. Guys, I also have to solve it with you, so it would be faster if you can solve and tell me the values. Okay, so this is minus 409.1, and this value, if you calculate, plus 100, uh, P given A, I is 10%, and N is 8 years. So what is the value in this case? If you go by the table for uh, P given A8, I is equal to 10%, right? It is 5.33. Mm. So that becomes into 5.33, that becomes minus 467. So you will see that the value you are getting lower, negative value is lower in the case of first option. So you will say that for further analysis I won't be considering this. I mean, if you have the choice directly yes or no, you will be only moving forward with this. So you know that in this case, in low volume case, you have got that the value is 409.1, right? Present value. Or do you have any confusion in this? Similarly, for medium, you can draw a similar cash flow, and it would be minus 1000 plus 200 uh, into P by A, 10% for 8 years, right? So that value we know to be 5.33. This comes out to be 66. So for this case, you have got 66, and now again you have got two choices. So let's make the cash flow. In last case, it's quite simple. 1000 plus 400 into 5.33. 1132. Now, what about the case that we haven't dealt till now? In this case, if you make the cash flow, how would it look like? You have got, you pay 100,000, I mean 1 million at time t is equal to 0. At first year, you are getting a revenue of 400. Then here again, you are paying 800. So for next 7 years, right? 1, 2, 3, 4, 5, 6, 7. For next 7 years, you are getting 600. So what will be the equation in this case? I will write it here. Minus 1000 plus, let's bring 400 to front, to first year, plus or minus, right? For 800, minus 800, bringing it again to first. Now what about the rest of the terms? 600 in plus. What is this? This is you have, this is A. So P given A, 10% for 7 years. So you brought it at time t is equal to 1. So now you have to bring it at time t is equal to 0. So it would be again 1 by 1.1, right? So what value are you getting in this case? Anybody with the calculator? Okay, what are the value are we getting? Guys, I will need some response and only then I can proceed. If you want, I will give you the value from the table for year 7. P given A is 4.87. You can take it as 4.87. So now what is the value are you getting? Anybody? Yeah. So you are getting this value around 1292.7. So which one is the higher value? Positive. So you can say that this is the better option. So if you are getting the net revenue of 400,000 in first year, we will expand. This is the better option. So discard with this. So now you have got this value as 1292.7. So if I ask you that what is the expected value, you will say this into zero point 0.3 plus 66 into zero point 0.6 plus this into zero point 0.1, right? Or any confusion in this part? Okay, so this comes out to be 46.14. That is a positive value and obviously greater than 0, right? So you will be going on with yes, let's build the new product. So is this calculation clear to you guys what we did here? We only focused on one parameter, like we calculated the expected value. So any question or shall we move forward? Okay, I will move forward only after getting a go ahead from you guys. Anybody who is ready to move on to the next question? Okay, so I am assuming that you have no doubts till this part. So now what you saw in this question was that we compared only expected value to determine how we should proceed. Now let's see another question. Consider the economic evaluation. This is some kind of an insurance question, insurance based question. You know that when we buy an insurance, uh, there is a higher probability that we might not even be using that insurance, right? We are just paying the amount and forgetting it. That is a kind of financial burden on us because we are not getting anything in return. I mean, yeah, there is some kind of surety, but financially, no, you are not getting anything. I mean, it's uh, very less probability that you will get something in return. So, in this question, what is happening is that uh, you are driving a car. car is sold, so you can you want to buy the insurance for your car. Now you know that 90% of the time there won't be any accident. So annually it would cost you zero, right? No accident. In case of small accidents, there is 7% chance that there can be some kind of small accidents, and in case of small accidents, you know that your average cost is, it is given that $300. What happens if it is a big accident? So 3% chance of big accident, and that cost you $13,000. You can say that it is a big number. 3%, $13,000. Now let's just focus on the probability. Okay, what is this? No accident, a small accident, and totaled. So you can say that anyway, if I'm buying insurance or not buying insurance, this probability will remain the same, right? I mean, I won't be changing my driving pattern that, oh, I have bought insurance, so let me drive very recklessly. It won't happen like that, right? Or will you think that, oh, I have got some cover, the insurance company will pay. Let me enjoy. Are you even connecting with the example? Okay, so assuming that you get what we are talking about, so these probabilities won't change in both the cases, right? If you buy insurance or you don't buy it. So if you buy insurance, what is happening is, this is the self case that you pay this amount. If you buy insurance, what happens is that in case of no accidents, again zero, insurance won't be paying you anything. In case of small accidents, the insurance company thinks that, okay, till $500 you bear it. So you are saying that if it's a small, again I will have to bear $300. But if your vehicle is totaled, I mean it's a big accident, in this in that case the insurance company is saying that whatever is the expense we will pay it to you, but the deductible is 500. So you can, I mean, insurance companies have these kind of terms, right? That we they have a fixed charge of, in this case they have a fixed charge of $500 for each claim. So even if you go for a small claim, you want a $300 claim, but they will be charging you the fees of 500. So you won't be going to them. But in case of total condition, your bill is 13,000. So you will be going to them. So instead of paying, and they will pay you 13,000, but for that the filing charge is 500. So you know that if your vehicle is totaled, you will only be paying 500. So now let's calculate the cost. Okay, cost of buying the insurance or cost of not buying the insurance. So if you are not buying the insurance, in case of self, you can say that the cost of accident would be zero point 0.9 into 0 plus 0.07 into 300 plus 0.03 into 13,000, right? And how much does it come out to be? It comes out to be 411. Now if you go for insurance, what figure changes is, again, into 300 plus 0.03 into, instead of 13,000 it's now only 500. So this value comes out to be 36. So now tell me, will you be going for insurance or will you not be going for insurance? The calculation is in front of you. So will you buy the insurance or not? Sorry, I couldn't hear you.
Not.
Uh, Okay, so you are saying that you won't buy the insurance, right? But you can see, okay, of course not. So let's see. Here, as you can see, that the cost you are getting is that in case of self, you will be spending $411 annually. In case of insurance, you will be spending $36. But you know that in case of insurance, there is some buying cost, right, of $800. So if you have to compare these two, you would say that going by self, you are saving how much? 836 minus 411 is equal to 425. Yeah. So you are saving $425 actually if you go by self insurance. Now, hmm, still people buy insurance. Why? I mean, we compared with the parameter that we have been using till now, expected value. In expected value, you see that buying the insurance is not a good idea. Yet people buy it. Why? I mean, I guess, okay, don't want to take the risk. But you see that taking the risk has lower cost. So there must be some other value that is guiding them to make the decision. Basically, we as humans, we love talking in terms of numbers. Okay. So is there something else that they are comparing? You can see that uh, there is okay. There were three other criteria that were discussed in class. So what were those criteria? Anybody? I guess that was in risk analysis lecture part 3. Okay, uh, if you're not going to the lecture again, how did you decide that you want to buy the insurance? If you're saying that you don't want to take the risk, then somehow you quantified it, right? In your mind, anyway. So there must be some other way to make the decision. Anybody? Okay. There was one that you considered that.
Due to government policies.
Um, I'm sorry, I can't hear you that clearly. Can you type it out? There were a couple of other criteria too. So what were those? Do you remember something about aspiration level or most probable future, expectation variance? Three things. Anybody? Okay. so I'm not getting any response. So I will move with these three terms. Okay. uh, Aspiration level. So let's say, not in this case, but if you fix that, okay, you will be only interested in some options that are giving you more than a fixed amount or only giving you positive values. So in that case, you can reject the alternates, right? Because they are below your aspiration. Now, most probable future. So in this case, what you compare is that if you have been given some probabilities, like in this case, what is, if you buy insurance, even then the most probable future is zero point 0.9, right? 90% chance of no accident happening. So that is costing you minus 800. I mean, that is costing you $800. And even if you go by self insurance, 90% chance of no accident happening. So that is costing you zero. So which is better? By most probable future also, you will go by self insurance. Now another thing is expectation variance. So in this case, you saw that the values you have to pay is either 0 300 500 or 0 300 13,000. So mentally you can see that just by adding this 800, this gap is very big. So you can see that the value is, I mean, the variance is very high in this case. So mentally you can see that the risk, if I take the risk, I will have to pay a lot, right? I mean, just in your mind you can see the case. So how to calculate this? So what we do is we calculate the standard deviation in this case. For standard deviation in case 1, you know that the value is how much? I mean, the expected value is, what is the expected value in case 1? 36, I mean 411 and 36, right? So how do you calculate the standard deviation? Anybody? So for the first case with insurance, what we are getting is zero point 0.9 into 0 square plus 0.07 into 300 square plus 0.03 into 500 square, right? uh, this is the ex- uh, expectation variance square, right? In case of buying insurance, so that is 13800. Similarly, in another case, it is how much? Zero point 0.9 into 0 square plus 0.07 into 300 square plus 0.03 into 13,000 square, right? So this value is 5076 300. Now if you calculate the standard deviation in both the cases, it would be, in first case, sigma would be under root of 13800 square minus 36 square, right? That is the cost in case of accidents, sorry, when you have bought the insurance. So that comes out to be 112. In second case, it is sorry, we don't have to square it because we are already taking the square values. So this is 5076 300 minus 411 was the cost, right? that comes out to be 2215. So you can see that this value is quite low. So variance is quite low in first case when you buy insurance. So can you see that now you have quantified the risk that we were talking about? Okay. Mm, So these examples were taken from the book Engineering Economic Analysis by Newman and Co. Uh, this is, this book is quite good with explanations. So coming back to you guys, do you guys have any question?
No, sir.
No question at all from everybody. Any doubt regarding to week 4's content or previous weeks or anything that you didn't understand in week 5 also that we can look up conceptually, or I will take it in the next lecture. I will remember that. Okay, so no doubt at all. Or anything that you want to discuss, or any question that you want me to repeat. Or let's do one thing. Uh, I'll repeat this whole in a couple of minutes.
Sir, good evening, sir.
Yeah. Good evening. Yeah. So can you?
Sir, can you hear me?
Yeah, I can hear you.
Sir, I joined very late and also I'm in traveling, sir.
Okay.
Sir, one request I will make is that if all these videos are available in our link, it will be good, sir. So that if we miss this session also, we can knowledge about
Okay.
the session.
Yeah, I will. Yeah, I will. I'll do that. So, anything regarding or any specific question, any specific doubt you would like to discuss? You guys have the content list in front of you. Okay, so in this lecture, we discussed about the values that we have to take, the actual uh, cost at this moment for the equipment. So here you can see that whatever it was happening, like 1600 minus 200, that is the cost. So that is the sunk cost, right? And we are not actually taking this into consideration. Why? Because you might have to take this into consideration in what cases? When you have got taxes, like if you include this part in any kind of depreciation calculation or some before tax after tax calculation, in that case you might have to use the sunk cost, but in our case we didn't have to use it. This question was that about about determining the most economic life of the machine. So here you saw that the the determining factor was the difference in the annual maintenance cost that we were getting. It can be annual maintenance cost or running cost or anything, the risk attached to it, right? If there is change in annual cost, then we need to go for further calculations. This question we did all the calculations, and I left it for you guys. Now, what what happened is that we found that Challenger Challenger over Defender has got a positive NPV. So positive NPV, that means its net annual cost or net annual benefits would be better than the Defender, right? So the cost of Challenger is less than the Defender, so it would be economical to replace, right? Then some simple probability question. Uh, Moving on to another question where we had probabilities about two things: the annual benefits and the life, useful life. So we determined the probability distribution from the given values and calculated the expected values. And we saw that in this case, as they are not mutually exclusive, they can happen together. So that means that you have got six cases, not three separate and two separate. And for that, you can calculate the joint probability. Right, we saw joint calculating joint probability, and similarly, if you have to calculate the uh, NPV, the expected value, what would it be for each and every case? Like for the third case I'm talking about, the cost is 25,000, right? Plus your annual benefit is 8,000. So that becomes your P given A. For I we have been given 10%. And what is the life for this case? The life for third case is 6 years. So you calculate that value, and what is the probability that it will happen? The probability is zero point 0.4 into 0.4. So similar thing you have to do for all 8 cases, and then you determine the expected value, right? Uh, then we saw a similar question, and we calculated the net present value, in this case expected savings, expected salvage, and put it into simple NPW formula. Similarly, we talked about the dam alternative, right? So how to read the decision tree, or you can say how to make the decision tree, and how to calculate the values, how to eliminate the options and find which is the best. And similarly, we talked about, in this decision tree we were only interested in their expected value. Now what happens if we are not so sure about the answer from the expected value? We saw that there are auxiliary criteria like aspiration level, most probable future, and expected variance. We discussed these things, right? So any doubt, anything? Okay, so I guess we'll end this session here. Thank you guys. Thank you for attending. Please let me know if there is some doubt regarding to this portion. You can directly message in the discussion forum.
Thank you, sir.
Thank you.
Sir, please
Yes.
put content slide once more.
Uh, so I can't hear you that properly. Can you be a little clear?
Please put content slide once more.
Which one?
Then all content slide.
Uh, so I can't hear you clearly. Can you type it out in
The
the?
topics including content that showed in clearly.
Okay, the topics we covered in the previous lecture.
Yes, yes, that content.
Okay, I will bring those contents again. Yeah.
Yes, sir. Okay, thank you, sir.
Okay.